According to Vanguard, the worst annual returns for an investment portfolio 100% in stocks resulted in a negative 43.13% loss. Almost half of the money gone. These huge losses of cash can be significantly reduced. Let's find out how. In this video, we will learn about the three major asset classes. First, let's define diversification. According to Investopedia, diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. Moving on to the three major asset classes. First, we have stocks, shares in a public traded company like Apple or Google. We have bonds, which represents loans made to governments, corporates, or agencies, typically at a fixed interest rate. And we have REITs, real estate investment trusts. This refers to land, buildings, cell towers, data centers, healthcare facilities, and more. Keep in mind, diversification not only involves diversifying across the three major asset classes, but also within each asset class. For example, the stock asset class has different sectors: technology, healthcare, financials, energy, and so on. Diversification into the three major asset classes works well because each asset class reacts differently to economical events, and this is where asset correlation comes in. To elaborate more, here we have market correlation data from JP Morgan. Correlation measures how closely returns of one investment tends to follow the returns of another investment. Ideally, we want assets that do not move together in order to reduce the risk of losing money in a market crash or a sell-off. Want to know the amount that can be placed into each asset class mentioned? Click right up here or link in the description below. Going back to the three major asset classes, here we have the stock column. The correlation between stocks and U.S. real estate, REITs, is of 0.1. It's far from 1. The correlation between bonds and U.S. real estate is a negative 0.2. REITs are far from moving together with bonds. Now, the correlation between bonds and stocks is of 0.3. It's still a 0.7 away from 1. All in all, these three major asset classes move differently from one another, helping us protect our money invested in case of a market crash or a sell-off, while providing better returns over the years. This video is only for educational purposes. We must do our own research. How do you diversify your investment portfolio? Let us know in the comments below. Like, comment, and subscribe so we can continue to learn.